So the big news this week was, well, big news. I guess that's relative if you're not in the finance business like we are. But CMHC, which is the Canadian Mortgage and Housing Corp, which provides mortgage insurance to millions of Canadians, they discontinued insurance today for second homes, and they changed the criteria for self-employed borrowers. So just to make sure we say this properly, a second home would be a vacation property, for example. So say that you wanted to buy a cottage on a lake, a summer place, but you didn't have 35% to put down. CMHC had what was called a second home mortgage that you could put down less than 35% and still be able to purchase that property. They've now done away with that program, so as of May the 1st, no luck if you're looking to buy a second home and you don't have the down payment. You won't be able to go to CMHC to get them to insure the mortgage that the bank hopefully is going to give to you. But then the second one, which is a little bit more, probably has more of an effect on the market, which would be self-employed individuals. CMHC, or back in a few years ago, it used to be that if you were self-employed, you could kind of say I'm a self-employed electrician and I make $90,000 a year. And for the most part, the insurance companies, because CMHC is not the only one, but the insurance companies providing mortgage insurance would say, is it reasonable that an electrician could make $90,000 a year? And if the answer was yes, then they would go ahead and simply approve the deal as if that particular individual had made that amount of money. And then the market changed during the downturn and insurance companies went, well, wait a minute, we don't want to have to kind of make an arbitrary decision like that. We want to see some kind of evidence that you make this much money. So we'd like to see a business license. We'd like to maybe see your articles of incorporation to prove that you're self-employed. And so there's a little bit of paperwork that was involved in order to do it. And now what the CMHC in particular has taken the step, and I'm sure the other insurance companies will follow suit shortly, but now they've said they want third-party verification. So they actually want to prove that if you're self-employed as an electrician and you say you make $90,000 a year, you now have to prove that you make that $90,000 a year. And so you wouldn't think that's troubling, except that for most self-employed individuals, assuming that they're profitable and they're making money, the way they take their money out of the corporation is usually through a dividend. And that's because on the advice of their accountant, a lot of times an accounting firm or an accountant who's doing the financial records or the bookkeeping for someone who owns their own business would say, look, pay yourself a dividend. That way you don't have to have a deduction for CPP and EI and go through your payroll system. The dividend is a much better way to do it. The problem with that is that dividends are not recognized by banks as actual income. There's a bit of work involved in proving to a bank that if you've consistently received this amount of a dividend, that it's sustainable into the future and it can be evidenced by the history. So now self-employed individuals are going to have to start figuring out how to prove to the bank that they make the money they say they're going to make, and the bank wants the insurance companies rather want third-party verification. So what does this mean? This means that if you're self-employed and you're going to have less than 35% or rather less than 20% to put down on a property, that you're now going to have to make sure you've got all the evidence available to you that you make the amount of money you say you make. And so while probably not going to have a huge effect on the marketplace, there's certainly a percentage of people that are self-employed that were able to purchase a home under this type of a program, and now they're just going to have to jump through some more hoops to do it. So my own opinion on this is, first of all, I think that these changes are all good. I'm a supporter of government getting involved. If I look at the Business Development Bank of Canada, for example, and the way during the downturn they were able to make sure that money was still moving in the marketplace when other banks had just simply decided they weren't going to lend, I think that there's a role for government. I think there's a place for government. In insurance, for me, the thing I always struggle with is that CMHC is so huge. They're just this massive, massive crown corporation, a company owned by the government. They make money. They're helping individuals get into homes. But there's other insurance companies in the private sector that could be picking up the slack, but they're just not. And I don't know if that's because they're not innovative enough. I don't know if they're not creative enough. I know that there's some subtle differences between the insurance offered by CMHC and the insurance offered by these other companies. But nonetheless, I think that these changes are good. I think CMHC does need to pull back out of the marketplace and allow private insurers to come ahead of them. But if private insurers aren't going to get ahead, if they're not going to be innovative, and if they're not going to try and be creative in how to help people purchase homes, then I mean CMHC kind of by default continues to fill the difference. So I think these changes are good. I don't think the changes affect a huge percentage of the market. I think it's contained to a very small group of people that were using insurance for a cottage, or maybe helping a child purchase a home when the parents themselves had a mortgage, or people who are self-employed. So I don't think it's going to send ripples through the industry, but hopefully it's the continuation of other changes that are going to see CMHC continue to pull out of the market and force private enterprise to figure out how to solve the difference and ultimately help Canadians continue to purchase homes. So that's our episode today. Hopefully you've learned a little bit about mortgage insurance. Hopefully you've gotten some tips on, if you're going to have a mortgage renewal coming up, how it's pretty easy to pick the phone up and talk to the bank that's offering you the renewal to see if you can get better terms. And we look forward to seeing you on the next episode. In the meantime, I encourage you to visit emilynow.ca. That stands for Making Life Easier Now.ca. And so if you're looking for a mortgage or a loan under $10 million for a commercial mortgage, a business loan, or maybe you're purchasing a residential property, that's the website that you need to go to see how much you can afford, what the payments are going to be, what the paperwork required is. And man, we've just made it so simple that in less than 3 clicks you can figure out if you're going to get approved or not. And then you can submit your request to us. We'll help place it at the bank for you. And if you don't want to use us, no problem. There's an option there where you can send it directly to the bank, and they're going to be able to pick up your application and get in touch with you. So thanks for watching, and we'll see you on the next episode.